My name is Jeffrey Muriuki from the School of Business and Economic, Department of Accounting and Finance. I'm going to take you through in the unit accounting for liability. Specifically, we are going to concentrate on the lease obligation. When you talk about the lease obligation is a way of acquiring an asset. We have so many ways you can use to acquire an asset. One of it being the lease. You can also buy an asset. You can also hire an asset. You can also do the renting of an asset. But for now, we are going to concentrate on the lease. There's no much difference between especially renting an asset and leasing an asset, although there are a lot of differences. So when you talk about the lease agreement, we are saying is an agreement where one party, and that indicates the lessor, the owner of the asset, is called a lessor, where one party transfers the right to another party, and the person who is getting the right, the asset is called the lessee. We are saying in return of a payment or a series of payment. We are talking of a payment or a series of payment because you can either pay in lump sum, you pay the whole amount of money that you expect to pay for the usage of another person's property. You can also pay in a series of payment whereby you are allowed to pay in a periodic basis. Maybe you have leased an asset for 5 years, you pay some amount in first year, another amount in second year, third year, fourth year, and fifth year. So for accounting purposes, we normally say there are two types of leases. We talk of finance lease, also referred to as capital lease. We also talk of operating lease. Those are two major types of lease that we have in finance. We are going to look at those type of leases, starting with finance lease. Finance lease is actually a lease that transfers all the risk and reward associated or incidental to the ownership of an asset to the lessee. And remember, the lessee is the person who is getting the asset or who is taking the asset from the lessor or from the owner. So once the lessee takes an asset from the owner, you transfer the risk and reward, or the risk associated. For instance, in case there's any insurance that is going to be taken as far as the asset is concerned, that the person who is taking the asset is the one who is going to cater for the insurance. In case there is any reward associated with the ownership of that property, then in that case still the person or the lessee is going to take that reward. Unlike not in rental, whereby you don't take the lease, you don't insure the property in case it's a rental. But in case of a lease, then you take, and it's a finance lease, then you transfer all the risks and reward associated with the asset to the lessee. Then the other thing we ask ourselves, what are the characteristics of the finance lease? How do you know whether it's a finance lease or operating lease? One of the major characteristics is number one, the lessee or the lease transfers the ownership to the lessee at the end of the lease period. You have gotten the asset for 5 years or maybe 10 years. What happens after the lease period is over? Probably the asset may be transferred to you or may not be transferred to you. In that case, the owner will be recognizing the fact that you have been paying some payment, which to them may be equivalent to the much you could have bought the property. So in case that property is going to be transferred to you after the end of the lease period, then automatically they become a finance lease. Number two, we are saying the lessee has the option to purchase. The asset may not be transferred to you as case number one, but now the option is on your side. You are the one to decide after the end of the period whether to buy the asset or not to buy the asset. And in case you are to buy the asset, very important, we are saying the price will be lower compared to the market price. You will not buy the asset at the same price as others may be buying in the market. No, you have been with that asset, so when you transfer that asset, we just require you to pay something small, so that we transfer the asset to you. It's not different from number one, because number one, you are saying you are not paying anything. The asset be transferred to you fully. But number two, you are saying we are transferring but at a lower price. Then number 4, you are also saying the this period is for a major term of economic life of the asset, even if the asset is not transferred. We may not transfer the asset as in number 1 and number 2, but what about the lease period? When you compare the lease period with the economic life of the asset, remember the economic life is that how long is the asset going to be usable to us? How long will the asset be used to generate revenue? We know like many assets, they have their life. The assets have got asserted life. So an asset may not be used forever. So some other asset may be used for 4 years, 5 years, 10 years. Of course, depending with the owner. If you prefer, for instance, to use that asset for 5 years, and now you are transferring that asset to another person, for instance, for 5 years or 4.5 years, then you see we are saying for most of the life of the asset, the one who is going to benefit is who? The person who is leasing the asset. Actually, the owner of the asset will not benefit from the use of asset in any way. So in that case, we have it as finance lease in case it meets that characteristic. Then lastly, we can also talk of the asset of specialized in nature, such as only the lessee, only the person who is to acquire the asset can use that asset. You can buy the asset, but that asset cannot be valuable to you in any way. Maybe in your production you don't use that kind of a machinery in your production. So even if you have it in your business, it is not valuable to you in any way. You can only give it out to another person who can make use of that asset. And in that case, then it means that the other person will use it forever or for the whole of its life. So we still rotate around number 3 because now you cannot use the asset even if it's your asset. You can only transfer that asset to another person. So when you transfer to that person who is capable of using that asset, then that asset becomes also the finance lease. As we are going to see later on, and you should note at this point, we don't have to meet all those characteristics for it to qualify to become a finance lease. Once it meets 1 or 2, even if it's one of the characteristics, then it automatically becomes the finance lease. Then you go to the operating lease. Operating lease is the opposite of finance lease. In case the lease does not actually meet the characteristic of the finance lease, then it automatically becomes the operating lease. So generally say that the lease or the operating lease does not transfer the lease and reward incidental to the ownership of the lessee. And as you are saying, it does not actually meet the characteristic of what? The finance lease or the capital lease. Then we move on to the accounting for the lease. How do you account for the lease? Remember, you're looking for the lease obligation. How do you account for the lease obligation? Like any other asset, or any other transaction that we carry out in the business, we have to account for rate in the book. For instance, we have to record how much. We are saying this actually a lease obligation. And the reason as to why we are calling it a lease obligation, because that property does not belong to us. It belongs to another person. We have not been given this property. This property, we have to pay some rental associated with it. So we have to, we have an obligation to be paying rent at the end of maybe at the end of every year. Furthermore, at the end of the lease period, we have to take back the asset to the owner. So remember, the obligation is any asset that you're holding and does not belong to you. It belongs to another person. So you are allowed to use that asset to generate revenue for now, but eventually you'll be required to return that asset to the owner. So how do you account for the lease? And specifically, we are going to concentrate on how we account for finance lease in the book of lessee. Remember, the lessee is the person who is taking the property. the property does not belong to the lessee. He is the one who is using the property, but the property does not belong to him. So in the book of the person who is using the property, he is going to create the obligation. Remember, he has created the obligation because the asset does not belong to him, it belongs to another person. So he has to recognize an obligation in his book. The question is, how do you recognize this obligation? You should note very clearly that the lease asset and liability should be recognized as non-current asset in the statement of financial position, and actually they are recognized as non-current asset, and in the statement of financial position classified as property, plant, and equipment. You're going to see that down. But for now, we see how we actually note that the asset obligation to be recognized is as follows. And remember, when you think of what is to be recognized, like any other transaction that normally take place in the accounting, we normally record in terms of money, We don't, for instance, record in terms of kg. We have bought a bag of maize, we don't say in account it is 100 kg. We record in terms of shilling, in monetary value. In account, we talk of monetary value in recording. Now we have acquired an asset in form of a lease. We have acquired, for instance, a motor vehicle. We have leased a motor vehicle. We may also have leased a building. The question is, how much are you going to recognize in the books in relation to that asset, in relation to that motor vehicle, in relation to that building that you have leased? How much are you going to recognize as an obligation in terms of sharing? Now that is where we are. How much are we recognizing? The amount to be recognized is the law of, number one, the value of the asset. Or number two, the present value of the minimum lease rentals. When you talk about Roman 1, we have to talk about the fair value of the asset. We are asking ourselves, in case we are to buy that asset now, the asset that we are leasing, how much could we have bought that asset? That is actually the fair value of that asset. Sometimes you can also refer to it as what? Market value. You can also refer to it as cash price. So the fair value is one of the things that we normally use to record. We compare that with the present value of the minimum lease rental. What is the lease rental? Remember, the asset does not belong to you. It belongs to somebody else. You have not bought this property. The question you are asking ourselves in number two, or what we are saying in number two, because the asset does not belong to you, you have to pay some rental after the end of a period. You may be paying after the end of the month, but mostly for lease, we normally pay after the end of the year. So after the end of every year, there's some lease rental you are supposed to pay to the owner of the property. The question is, what is the total lease for the usage of that property? For instance, assuming that you have leased that property for 5 years, and every year you have to pay 20,000, it means by the time you add the lease, you are going to have paid 100,000. But now, remember, in finance and in accounting, we don't just take the amount in total. We have to calculate the present value of the amount. We have to recognize the fact that the amount that you are paying in the first year is not equivalent to the amount you are paying in the second year. It is not even equivalent to the amount you are paying in the third, fourth, or the fifth year. Remember the present value of money. It keeps on changing as time goes. If I give you 10,000 today, you cannot tell me it's equivalent to 10,000 after 10 years. The one who is given 10,000 today may benefit more than the one who is being told, I'm going to give you 10,000 after 5 years. That is where we calculate the present value. We are going to receive an amount at the end of the second year, or you are going to pay, in our case, an amount at the end of the second year. The question is, what is the present value of that amount today? if you compare, what is the, if you relate it with the, for instance, in case you are paying 10,000 after 10 years, we may say the amount equivalent to that today is 80,000. So we are saying when you want to get the amount to recognize for the lease purposes, you compare the fair value with the present value of the lease rental that you are paying. Remember, it's not just lease rentals, but you have to calculate the present value of the lease rental. The lower of the two is the one that you are recognized in the book as the obligation. Remember, in the book, you always do what? As you are going to see the entry. So with the lower of the cash price or the present value as explained above, you debit the asset. You have acquired an asset in the business. So you know that you have brought an asset in the business. So when the assets are increasing in business, we normally debit the asset. And then remember that every time you debit a transaction, you have to credit another transaction. What are you crediting in this case? It is the obligation, the finance obligation. You debit the asset, then you credit the finance obligation. Then, subsequently, you may be required, actually maybe at the end of the any period, you may be required to pay a certain amount of money. When you pay, then what happens? And then you debit the lease obligation. When you are debiting the lease obligation, you are actually reducing the obligation. In the first instance, I take you back there. When you created the obligation, you credited the obligation. But as you pay, with the amount that you pay with, then you reduce that obligation by debiting the obligation. And of course, mostly the amount may come from the bank or cash. It can be bank or cash. So in case you come from bank, you debit bank. In case through cash, you debit cash. Remember, we may have some interest allocated for the year. You have somebody, it's just like someone has given you some loan. So you're not only paying for the loan, you're also paying for the interest associated with that loan. So in case there's any interest associated with the lease, then what do you do? You debit the finance cost. Finance cost is the cost of the, for instance, interest. Interest comes as a result of getting the finances. That is why we refer to it as finance cost, the cost of getting those finance. So you debit the finance cost, then you credit what? The lease obligation. And remember, when you are crediting the lease obligation, you are actually increasing your obligation now by the interest. Actually, the effect of any interest, even when you get a loan, is to increase your obligation. So any interest that arises, can you credit that to the lease obligation so that you can increase your obligation? In case there's any depreciation, and in most cases you are going to have depreciation from the asset that you have acquired, then you debit the profit and loss account and credit the accumulated depreciation. Remember, depreciation comes as a result of usage of the asset. When you are starting with the asset, the value of that asset was 1 million. After 1 year, you cannot tell us the value of that asset is still 1 million. It may have depreciated. It may have lost value. So the value that the asset has lost is the one we refer to as what? Depreciation. And what do depreciation again? You debit P&L or profit and loss or income statement, and the credit will go to the accumulated depreciation. And I want us to see an illustration so that we'll be able to move on. So we have Mentor Limited leased a machine from Super Machine Limited. The term of the lease was follows. Inception of the lease, or when you are starting the lease. When did you start the lease? Is the one you are calling, referred to as inception of the lease. It was 1st November 2016. Then we have this term period, or the period you are going to have that machine is actually 4 years. And the amount you are going to be paying per annum is actually 78,864. 78,864,864. 864,000 every year. That's the amount you are going to pay for the usage of another person's property. And remember, the amount is payable in arrear. In arrear means that you are paying after the end of the period. It is different from you are paying in advance. You know, in advance is when you say that, can you pay me faster before you use the property? Like now, in case of rental, you have gotten a house, a room from somebody for rental purposes. You know, you normally pay before the month starts. But there are other cases whereby you can even be allowed to occupy the room first, and then after the end of the month, you pay. So in case you're allowed to occupy the room faster, then you pay after the month is over, then you say you are paying in arrear after using in that period. But in case you are told, can you first pay me before you started using that asset in that period, then we talk of payable in advance. But for now, in our case, you are talking about payment being done in arrear. So interest rate implicit in the lease or associated lease is 10%. So for the purpose of calculating the return, and actually what brings about this concept of the present value is the interest. You know, the value of the money, interest goes on increasing with the time. So what is the interest? What is the market value of the interest? You know, we are guided mostly by how the economy is going, but mostly depending with one business or the other, because there's no policy that you must use 10%, 9%, you may use an interest rate that you may think is fair to you as a business. Then the useful life of the asset is actually 4 years. Remember, you said the useful life of the asset is that time that asset is likely to be useful to you for the production purposes. You may have, for instance, a motor vehicle. Someone may say, this motor vehicle is only going to be useful to me for 20 years. Some say for 10 years, depending on one person to the other. But in case of this machine, we are saying this asset is only going to be useful to me for only 4 years. After that, it can no longer be used for production purposes. Then you are required, number one, identify it. You identify the type of the lease. And then number two, extract from the financial statement of Mentor Limited for the year ended 31st October 2017, 2018, 2019, and 2020. We start with number one. We are asking ourselves, what type of the lease are we dealing with? I take you back to the characteristic. What did you say about the characteristic? We actually said that there are various characteristics or things that normally used to differentiate or to be able to know whether you're dealing with the operating lease or finance lease. And now one of the characteristics that we said is number three. We said that the lease period is for a major term of economic life of the asset. Or in short, we are saying the lease period is almost equal to the useful life. And hoping you're able to differentiate between the lease period and the useful life. Useful life is for how long is that machine going to be useful for production purposes. Then the lease period is for how long are we going to have given out this machine. So you can see it is useful in our case. It is useful for 4 years, and the useful life is 4 years. So the useful life of the asset and the lease period, they are almost equal. So I have bought the property, and that property is only going to be useful for 4 years. I've given that property to you for the 4 years. So for me, I'm not benefiting from that property in any way, because you are the one who is going to be having that property for the time it's going to be economically useful. And for that reason, we are saying this is a finance lease, because the lease period and the useful life, they are equal. Even if they are not equal, but they are almost equal, then we take it to be capital lease or simply finance lease. Then you go to number 2, whereby you are required to come up with the extract of financial statement. And remember this for mentor, not super machine. Super machine is the owner. So in the super machine book, you are going to have the asset, but in the mentor limited, you are going to have the obligation. Remember in finance, when someone is talking of an obligation, the other person is talking an asset. I've gotten a loan from you. In your book, you are saying you have an asset somewhere. But in my book, I'm going to be talking of obligation. So for the purpose of accounting for liability, we are going to concentrate on mentor limited, who is getting the machine. So he is the one to recognize the obligation in his book. Remember, the first thing we do is to calculate the amount that you are going to recognize in the book, because now you have the machine. But how much are you recognizing in the books of the account? Are you going to recognize 20,000 in the book? Are you going to write 30,000? Are you going to write 1 million? No, you have just got the machine from somebody, but you don't know the much you are going to write in the asset account or in the obligation account. So we always start. The step number 1 is, can you start by calculating the amount that you're going to recognize the book? And as we said, it's the lower of the fair value of the cash price of the asset. You compare that with the present value of the minimum lease rental payable. This another there we are saying that the cash price has not been given. Actually, you don't have any information to do the cash price from the information given. So when you have no information, so use the one that you only use the one that is available. So we cannot use number 1 because it's not given. So you automatically go by number 2, whereby we calculate the present value of the lease rental payable. From financial management concept, how do you calculate the present value? We start with the amount that you are going to pay in the future. The amount that is payable in the future from the illustration, we said every year you are paying 78,864 in year, for 4 years. In year 1, you pay that 78,864. In year 2, you still pay that. In year 3 and year 4, you still pay 78,864. But remember, we said the amount that you paid in first year cannot, the 78,864 you paid in first year cannot be equal to the one you paid in second year. Can you calculate the present value of every amount so that you'll be able to compare them currently? Remember, the lease is being taken now. So we want to calculate the present value at the point of the lease or when we are starting the lease. How do you calculate the present value? We always take the amount, you multiply by 1 divided by what? 1 plus R raised to power N. Hoping you have that formula from financial management. 1, you multiply by 1 divided by what? 1 plus R, you raise to power N. In our case, R is 10%. 10% given. This is the interest rate. R for interest rate is 10%. That is why we are saying 1 plus 0.1, you get 1.1. The period in year 1, the amount you paid in year 1 is 78,64. So you multiply by 1 divided by 1.1 raised to power 1, because that's the amount for period 1. When you go to period 2, the amount you paid in period 2 of 78,64, you are going to raise to power 2, because you are calculating the present value in period 2. You go on in period 3, you raise to power 3. In period 4, you still raise to power 4. And we should get much of this concept by from financial management books. When you add all those present value, therefore we are saying the present value is 250 million. This is rounding off. We are rounding off because we are just estimating for the purpose of decision making. So you don't just take the amount payable as 78,864,000 times 4. You have to calculate the present value. And now you have calculated the present value, and the amount is actually turning up to be around 250 million. So 250 million is the amount that you are going to recognize in the books of accounts. Remember, we start by saying when the lease starts, we debit the asset, we credit the lease obligation. So you debit the amount, the asset. When you ask, you have brought more asset. How much is the increase of that asset? The increase of the asset is by 250 million. So you debit the asset. Now that you have increased the asset, you have now increased the obligation. It's just like when you go to the bank, you get some money from the bank in form of a loan. You get 20,000 from the bank, you have increased the cash that you have. So that's an obligation you have increased, but on the other hand, you have also increased the cash that you have. So here you are bringing the machine. And the machine value is 250 million. That is where we are debiting the plant machine and equipment. But now we also increase the obligation because that machine does not belong to us. It belongs to Super Machine Limited. So you debit 250 and credit the obligation is 250 as calculated from the present value of the minimum lease rental payable. Then after that, the second step is to come up with the lease obligation amortization schedule. You know, the purpose, you know, the requirement is we are supposed to come up with the financial statement extract. But we are not able to come up with the financial statement extract unless we first come up with this obligation so that, for instance, we get the closing balance, they want to get to take the balance sheet and the interest to be taken as an expense in the income statement. So can you always come up with the amortization schedule? When you talk of amortization, amortization is actually reducing. You know, you reduce with the time. You started with 250, the figures are in thousands. You started with 250 million as recognized above. The amount that you actually recognize is 250. That's the obligation that you started with. The obligation you started with is actually 250 million. Then, in the course of the period, you increase the obligation by the interest. You know, the effect of interest on the loan is to increase your obligation. So the interest rate is actually 10%. So 10% times 250, you get 25. So the obligation is going to be increased by 25 million because the figure is in thousand. So you can no longer be talking of obligation 250, but it's 250 plus 25. But don't forget that you're also paying the amount you are paying. The effect of amount paid is to reduce the obligation. Don't forget that. The effect of interest is to increase the obligation. But the effect of the amount paid is to reduce your obligation or your liability. Another name for obligation is actually liability. Now, in our case, very first you are saying it is 250 plus 25. You less what? 78 is 64. So that the closing obligation is actually 196, 136. What was closing last year is the one that is in 2017 is the one that is going to open in 2018. You do the same. You calculate the interest rate. It is 10% times 196, 136. You get 19613.6. Don't ignore the point because the figure is in thousand. Then you less the amount paid, you get 136. You go on until you go to the last year whereby you started with 71,711. The interest is allowed 71.53. Then we less the amount that you paid to be left with the nil. And that is what we refer to as amortization schedule. You know, we want to show how has the obligation be increasing and decreasing until we have nil obligation at the end of the lease period. So that's the amortization schedule. With that now, we can move on to the income or extract. Remember the requirement was we are supposed to come up with what? We are supposed to come up with the extract of the financial statement of Menta Limited. When you talk of financial statement, there are two types of financial statement. We can either talk of statement of financial position, also referred to as what? Balance sheet. And also we can talk of income statement. This is income statement. This is actually mental limited statement of financial position. And at the financial position, we have to, when you're told to prepare the financial statement of financial or income or statement of, we are preparing either income statement or the statement of financial position. In the income statement, this is just an extract. So when you talk of an extract, we are only concentrating on those things that are affecting us, or those things that are available. We don't give everything. We are only interested with what is available to us. Remember, this is actually the income statement or the statement of financial position by the income statement. So the only thing that we are going to have from is the interest that you are paying. Remember, from amortization schedule, we have the interest, the various here. We have the interest. In the first year was 25 million. The second year was 13.6. The third year was 3688.56, and the fourth year was 71.53. And that is what we are going to show in the income statement extra. So under the expense, we are only going to show the interest because that is what is available. It's an extract. So in the various year, the interest in the various year from the amortization schedule. We also show the depreciation in various years. How do you calculate the depreciation? We use the straight-line basis, although there are other methods, but for now, we can, when you are not be told about the method to use to calculate the depreciation, you are free to use any method. But mostly in lease, we normally use the straight-line method, whereby we take the cost, you divide by the what? By the life of that asset. In our case, the cost is actually 250. Don't forget, the cost was 250, and the useful life is 4 years, which is also equal to this period. If you take your calculator, take 250 million, divide by 4 years, then it means that every year you are losing 62,500. Actually, the concept of depreciation is to say, you have an asset. That asset will not be there forever. There's that amount that asset is actually losing every year. How much is that asset? You just take the useful life of the asset. If the asset is going to be there for 5 years, you take the cost divided by 5 years so that you can see on average how much are we losing as pertaining to that asset. So in our case, we are losing 250 divided by 4 years. So every year we are losing 62,500. So that is the amount we are showing as depreciation in our account. That was the income statement. After the income statement, you go now to the statement of financial position. Statement of financial position for the 4 years, 2017, 2018, 2019, and 2020. Remember, another name for statement of financial position is actually the balance sheet. So whether I talk about the balance sheet or the statement of financial position, they actually mean the same. The income statement that we have here, or the statement of financial position for the 4 years, in the income or the statement of financial position or the balance sheet, we mostly show say that asset is equal to what? Capital plus liability. But remember, this is an extract. This is an extract. So being an extract, we are not going to show everything. We are only going to show what is available to us. And mostly in our case, we are only interested with what? Mostly the liability part, although you can still show how the non-current asset is affected. So for non-current asset, it's actually a bit easier to understand, because now we start with the cost minus what? Minus the depreciation. The cost minus depreciation. What was the cost? I still take you back there. The cost, the amount that you recognize in the asset is actually 250 million. That is the amount of the asset that you have. That's the cost, the total cost of the asset. You calculate the book. That is what we started with. We started with 250, but in the course of the year, we lost how much? We lost 62,500. That's the depreciation, the amount we lost in regard to the asset in 2017 was 62,500. So the question is, what will be the value of that asset at the end of 2017? It is actually 250 minus 62,500. 250, the amount we started with, minus 62,500 being depreciation, so that you can get now the value being 187,500 at the end of 2016 or 2017. Then come 2018, what will be the value of that asset? Or what will be the net book value of that asset? It is now the value we added with last year minus what it lost this year. We added with 187,500. You less the depreciation of 62,500 to be left with what? 125. Then come the other year, how much did it lose? What was the loss? It is actually now 125 million. You less 62,500 to be left with 62,500. Come the last year, how much did it lose? It is actually now 62,500. You less still 62,500, the depreciation the last year to be left is zero. So by the end of the useful life of the asset, you are saying there's nothing to be recognized in the book. Hoping you are understanding, because now at the end of the period, you have nothing to recognize in your book. So you have zero to recognize. The asset is fully depreciated. It is fully depreciated. Come to obligation. Obligation, I wish you note, for the purpose of presentation. For the purpose of the presentation of the, especially in the statement of financial position, we normally classify the obligation into either current or non-current liability. We actually split the obligation you have into either non-current liability or to current liability. Remember, the current liability obligation is the obligation that is payable within the next one financial period. We are in period A, or in a certain period. And like now you're in 2020, you might be having a certain obligation. And the obligation, as you have been saying, is what does not belong to you. That is what we refer to as obligation. The question is, what will be the obligation? Are you still going to be having the obligation at the end of the current year? In case you still be having the same obligation or obligation, then the obligation you'll be having is what we refer to as non-current obligation. But the obligation that you expect to pay within the next one financial period, or within 1 year, in short, we normally refer to it as current obligation. So even here for the lease, the lease liability that you have should be split into either current obligation or to non-current obligation for the purpose of presentation. If, for instance, I take you here so that you can understand what we are saying, we have an obligation at the end of 2017, or at the start the obligation was 250, but of course you remember what we did we increased by 25 and reduced by 78, so that at the end of the period, we are now comfortably saying our obligation is no longer 250, but our obligation is what? 196,136,000. That's our obligation. But now come 2018, the obligation is still reducing. It is no longer now 196,136,000, but now our obligation we are saying is 136,885.6. It's just like when you have a loan. You say you started with 250 million, but now, after some times, my loan is no longer 250, it is 196. After that, another year, you are saying now it is 136 million. After another year, you are saying my loan now is 11,000. Now, after the end of the loan period, or in a case after the end of the lease obligation or the lease period, we are now comfortable saying the obligation is nil. So remember, these are the obligations that you're recognizing in the statement of financial position. In year one, we had 136,000. But we have been saying, and we are saying that the obligation, like now in case 196, we have, it is composed of 1, current liability, and 2, non-current liability. Here we have current liability, we still have non-current liability. The same case with the second year, as you are going to see. We have, out of 136,885.6, part of it is current liability, is going to be payable within the next one financial year. Another part is non-current. It will still be existing after one financial year. Now the biggest question is, how much is payable? How do you know what out of 136, the amount that is payable within the next one financial year? To know the amount that will be payable, we can start by knowing the amount that will be existing the next year. The amount that will be existing is 136,885. So what does that mean? If the amount you started with is 196, and at the end of the period the amount will be 136, it means that the amount that you have paid is the difference between 196 and 136,885. It's just like when someone give you, when you have a liability of 1,000 at the beginning of the year. You had 1,000 as a liability at the beginning of 2020, or in our case, let's talk of 2020. And then someone is telling you, by the time you are coming to 2021, you are no longer talking of obligation of 1,000, but the obligation was now 700. What does that mean? When you are in 2020, beginning, or you are in 2020, then 700 you'll be saying it will still be there at the end of the year. It will still be there after 1 year. So the amount that will not be there after 1 year is 1,000 minus 700, because the amount you have been paid already. So the same case you are saying here. The amount you started with is actually 196, 136. After 1 year, or at 2018, the amount has lowered to 136,885. So when you are here in 2017, it means 136 will be non-current, and the difference will be the current. The difference is the one that is going to be payable in 2017. So that when you come to presentation, 136 is non-current. It's non-current because it will still be there. It will still be there. 136 will be still be when we are presenting the year 2017. Out of 136, 136 we are saying it will still be there next year. And only the difference between 196 and 136 is the one that is not going to be there, and the difference actually in our case is 59 to 50. So that when you add 136 plus 59 to 50.4, you get the total obligation of the figure you are calling 196. So we are split 196 into 136,885.6 and 55 to 50.6, so that we will be able to know the non-current obligation and the current obligation. Come the following year, you do the same. Out of the obligation of 136, you are in 2018 now. You are doing the account for 2018. In 2018, you have a total obligation of 136 in 2018. So out of 136,885.6, how much was current and how much was Non-current, by now I believe you can answer that question. The amount that is non-current, the one that will still be there next year is 71,711. And therefore, the amount that will not be there, the amount will be paid by next year, it is the one we have today minus the amount we shall be having then. So the amount we have today is 136. The amount that we shall be having come 2019 is 71. So the difference, of course, is the one that you are going to pay. So in our case, we are saying it is non-current will be 71,711, and the current, the one that you expect to pay the following period, is 75,174.6. And come the last year, we are saying, of course, come the last year, we are saying the obligation is actually 71,711. And by the time we come to 2020, we will be having a nil obligation. Meaning what? That everything is current. We don't expect to have any obligation by the end of 2020. So everything is now going to be treated as current obligation, and nothing will be non-current. Non-current is now 0, and the current obligation is now is actually 71,711. And of course, in 2020 we have no obligation. The obligation is fully paid. You don't have any obligation. So you don't have a current obligation, and you don't have a non-current obligation. Everything has been paid. So remember, our major interest in accounting for ability is this part whereby you are accounting for non-current ability and current ability. So when you are accounting now for the asset, the major part, of course, is non-current asset. Although as far as the current asset and as far as the accounting for asset, accounting for ability are concerned, they go together. Remember, as you have been saying, when someone is talking of accounting for ability, the other person is accounting for asset. I'm the owner of the asset, so I'm accounting for the asset. I've given that asset to another person. When I'm accounting for that asset as an asset, the other person is accounting for liability. So that's the accounting for this, and specifically, remember, you are concentrated on accounting for this using when it's in arrear. I would also wish you use the same example, illustration we had given. You can assume the same figures or the same data. You can assume 1st November 2016, but for the lease period, this period you can still assume 4 years, but for the other one, the amount that you are paying, just assume it's payable in advance. Advance, because you can get a question of that nature, whereby now they are not payable in advance, but they are payable in, actually they are not payable in arrear, but they are payable in advance. I can only give you a hint, because when the only difference will come when you are calculating the present value of the minimum lease rental payable. When it is in arrear, the first payment was made after the end of period 1. That is why we also had to raise to power 1. But when it's in advance, it all means that the first payment is going to be made when you are starting the lease. At the beginning of the lease, you first pay 78,864 before you start the lease. Unlike now, in the case you have just done whereby you are being told the first payment is after the end of year 1. But now, in advance, you are told, can you first pay us in advance? So in that case, when in advance, in case it was in advance, the lease period, the first payment we could have raised to power 0 because you are paying now. The second payment is going to be after the end of year 1. So in case in advance you raise to power 1 for the second payment. For the third payment, you raise to power 2. And the fourth payment, you raise to power 3. Because of course the fourth payment is going to be made after the end of year 3. So that's the only difference, whereby the difference will now only come when calculating the minimum lease, the present value of the minimum lease rental payable. But all other things are the same, whether in advance or in arrear. So you can try to calculate when in advance, and then you calculate the balance sheet extract and the statement, income statement extract, so that you can see whether you have understood. But the major part that you are supposed to understand, of course, as you are saying, is how to come up with the income statement extract and the statement financial position extract. But you are not able to do that unless you first calculate the amount to be recognized in the books. You also go ahead and come up with a lease amortization schedule, so that you can get what to take the balance sheet and what to take the income statement. Like now, interest is the one that is going to the income statement, and the closing balance are the ones that are going to the statement of financial position. Remember, in the financial position or income statement, we normally talk of what? For the year ended. So you're interested with whatever happened in that year. What happened in that year? So like now, interest that accrued for the whole year, we bring it here as an expense. Depreciation for the whole year, you bring it there. But in the statement of financial position, we only bring the closing balance. The balance at the end. The balance at the end is what we are interested with. So what has been paid, we are not interested in that. We are only interested with the balance. And with that, we come to the end of presentation, and hoping that you have understood everything that we have been covering. It's just a matter of practice, and for purpose of practice, you are always advised, can you start with the example that have been done in class? Once you have done that example, go to the library and get another example that has been solved. And after that, can you try to solve the example that you did in class without referring to the answer? And later on, you can move to other example that may be complicated. And don't do it alone, do it with a friend. Because when you are together, you understand more than when you are alone. Otherwise, thank you for the class, and wishing you a quick understanding. Thank you.